Welcome. If you're watching this, you likely hold gold or silver, or you're considering entering these markets. Either way, what I'm about to share with you matters deeply to your financial future. The title of this presentation isn't designed to alarm you. It's designed to get your attention. Because right now, at this particular moment in market history, precious metals holders face a series of critical decisions that will determine whether they preserve wealth or inadvertently destroy it. Let me be direct with you. The danger facing gold and silver investors today isn't what most people think. It's not a market crash. It's not government confiscation. It's not a conspiracy to suppress prices. The real danger is far more subtle and far more common. It's the danger of making perfectly rational decisions at precisely the wrong time. It's the danger of holding an excellent asset class in the wrong way, for the wrong reasons, or with the wrong expectations. I've spent decades studying financial markets. I've witnessed multiple precious metal cycles. I've seen fortunes made and lost, not because the metals themselves failed, but because investors failed to understand what they owned and why they owned it. Here's what concerns me most. Many gold and silver holders today entered these markets during specific conditions that no longer exist. They bought based on narratives that may no longer apply. They're holding positions designed for a world that has already changed. At the same time, potential investors are watching from the sidelines, paralyzed by contradictory information. Should they buy now? Should they wait? Are prices too high? Too low? The confusion is understandable. This presentation exists to cut through that confusion. We're going to examine what's actually happening in precious metals markets right now. We're going to discuss the forces that drive these assets over time. And we're going to establish a framework for making intelligent decisions regardless of what happens next. I won't predict prices. I won't promise you wealth. What I will do is provide you with a professional-grade understanding of these markets and the strategies that have stood the test of time. Because here's the truth that changes everything. Gold and silver are not typical investments. They don't behave like stocks. They don't respond to the same incentives. They serve different functions in a portfolio, and they demand different management approaches. If you treat them like stocks, you'll make stock investor mistakes. If you treat them like lottery tickets, you'll eventually lose. But if you understand them properly, they can serve you extraordinarily well. So let's begin. Let's examine what you really need to know about precious metals right now before making your next move. Before we discuss strategy, we need absolute clarity on what these assets represent. This might seem basic, but I assure you, most investors get this fundamentally wrong. Gold and silver are not investments in the traditional sense. They're stores of value. They're monetary metals with thousands of years of history. They're insurance policies against specific types of economic disorder. When you own gold, you don't own a business. You own no cash flow. You receive no dividends. The metal sits there, unchanging, while the world moves around it. This is not a weakness. This is its fundamental nature. Silver carries similar characteristics, but with an important difference. Silver straddles two worlds, monetary metal and industrial commodity. This dual nature creates unique opportunities and unique risks that we'll address shortly. Understanding this distinction matters because it changes everything about how you should approach these assets. If you bought gold expecting stock-like returns, you misunderstood the purchase. If you bought silver hoping for a quick double, you may have set yourself up for frustration. These metals perform specific functions. They preserve purchasing power over long periods. They tend to maintain value when currencies lose it. They provide portfolio diversification because they often move independently of stocks and bonds. But they don't grow businesses, they don't innovate, they don't compound. They simply exist, maintaining their intrinsic properties regardless of human opinion. Now, let's discuss where we stand today. The precious metals market exists within a specific economic environment, and that environment is historically unusual. We're living through a period of unprecedented monetary expansion. Central banks have created more money in the past 15 years than in the previous century. This isn't conspiracy theory. This is documented policy. At the same time, we're seeing debt levels across governments, corporations, and households that have no historical parallel. Global debt to GDP ratios have reached levels once considered impossible. Interest rates, after a brief period of normalization, remain historically low when adjusted for inflation. Real rates, nominal rates minus inflation, have been negative for extended periods, something that rarely happened in previous generations. These conditions theoretically favor precious metals. In theory, currency debasement should drive people toward hard assets. In theory, negative real rates should push capital into non-yielding stores of value. Yet the market doesn't always behave theoretically. Prices move based on sentiment, positioning, and flow dynamics as much as fundamentals. This creates the tension we see today. Gold has reached levels that seemed impossible just a few years ago. Silver has shown strength but remains historically cheap relative to gold. Investor sentiment swings between euphoria and despair sometimes within the same month. This brings us to the first major danger. The psychology of precious metals investing differs fundamentally from other asset classes, and most investors are completely unprepared for it. Precious metals attract a specific type of investor mindset. People often come to gold and silver during moments of fear. They're worried about currency collapse, government overreach, financial system failure, or economic catastrophe. These concerns may be entirely rational. History shows that currencies do fail, systems do break down, governments do overreach, but fear-based investing creates psychological vulnerabilities that market cycles ruthlessly exploit. When you buy an asset based on disaster scenarios, you create a problematic dynamic. If disaster doesn't arrive on your timeline, you become frustrated. You start questioning your decision. You become vulnerable to selling at exactly the wrong time. Conversely, if prices rise sharply, fear-based investors often interpret this as confirmation that disaster is imminent. They double down. They overconcentrate. They abandon diversification and risk management precisely when discipline matters most. I've watched this pattern repeat for decades. An investor buys gold at $100 or $200 per ounce, convinced that hyperinflation is months away. Inflation doesn't materialize. The investor holds through $1,000, $900, $800, growing increasingly bitter. Finally, they capitulate near the bottom, selling at $1,050 just before the next rally begins. Or consider the opposite scenario. An investor buys silver at $18 per ounce. It rises to $28. Instead of taking some profit, they hold everything, convinced it's going to $100. When it corrects to $22, they panic and sell, locking in unnecessary losses. Both investors owned the right assets. Both destroyed wealth through emotional decision-making. Understanding market cycles is essential to managing precious metals intelligently. These assets don't move in straight lines. They move in extended waves that can last years or even decades. A typical precious metals bull market doesn't unfold gradually. It consolidates for extended periods, testing investor patience. Then it advances rapidly, often when pessimism is highest. It consolidates again. It advances again. This pattern repeats until the cycle exhausts itself. Bear markets work similarly, but in reverse. Prices decline. They bounce. They decline further. They bounce again. Each bounce convinces some investors that the bottom is in, only to be followed by another leg down. The 1970s bull market in gold lasted roughly a decade, taking gold from $35 to over $800. The subsequent bear market lasted 2 decades, taking it back below $300. The bull market from 2001 to 2011 lasted a decade. The correction from 2011 to 2015 tested every holder's conviction. Silver experiences these same cycles with higher volatility. The moves up are more dramatic, the moves down are more brutal. This creates both opportunity and danger, depending on how you approach it. Right now, we're in an interesting phase. Gold has broken through previous all-time highs. Silver has shown strength but hasn't matched gold's performance. This divergence tells us something about market psychology and positioning. Many precious metals holders today base their positions on inflation expectations. This makes sense theoretically, but it contains hidden dangers you need to understand. Yes, gold and silver have historically performed well during inflationary periods. Yes, current monetary policy creates inflationary pressures. But the relationship between inflation and precious metals prices is more complex than simple correlation. During the 1970s, gold and silver soared as inflation ravaged the economy. But in the 1980s and 1990s, inflation remained present while precious metals collapsed. Why? Because real interest rates turned positive and investor sentiment shifted dramatically. In the 2000s, gold rallied despite relatively moderate inflation. The driver wasn't consumer price increases. It was currency debasement, negative real rates, and loss of confidence in financial institutions following the 2008 crisis. Today, we face a different environment. Inflation has emerged, but central banks have responded by raising rates. This creates cross-currents. Higher inflation supports precious metals. Higher nominal rates pressure them. Which force wins depends on how the situation evolves. Here's the critical point. If you bought precious metals solely because you expected high inflation, you've tied your investment thesis to a single variable. If that variable changes, or if the market stops responding to it, your thesis breaks, and you have no framework for decision-making. Successful precious metals investors understand multiple drivers: currency debasement, real interest rates, systemic risk, geopolitical tension, central bank policy, and physical supply-demand dynamics. They don't rely on any single narrative. Silver deserves special attention because it presents unique opportunities and unique risks that gold doesn't share. Silver's industrial demand creates both support and vulnerability. When economies grow and manufacturing expands, silver benefits from genuine consumption. Solar panels, electronics, medical applications, these create real demand that must be satisfied from physical supply. But this same industrial component makes silver economically sensitive. In recessions, industrial demand collapses. This creates downward pressure even when monetary factors would theoretically support prices. Silver also trades with more extreme sentiment swings than gold. The silver community is passionate, sometimes to a fault. When optimism peaks, silver can rally violently. When pessimism dominates, it can fall just as hard. The gold to silver ratio, how many ounces of silver equal 1 ounce of gold, provides important information. Historically, this ratio has averaged around 60.1. It's reached extremes above $120.1 during silver bear markets and below 30.1 during silver manias. Currently, the ratio sits in a range that suggests either gold is expensive relative to silver or silver is cheap relative to gold. Which interpretation is correct matters enormously for portfolio decisions. We need to address a contentious topic in the precious metals community: the distinction between physical metal and paper claims on metal. Physical gold and silver coins or bars give you direct ownership. You hold the metal, you control it. No counterparty risk exists beyond theft or loss. This appeals to many investors seeking true independence from the financial system. Exchange-traded funds, mining stocks, and futures contracts offer exposure without physical possession. They provide liquidity, easier storage, and sometimes leverage, but they introduce counterparty risks and don't provide the same insurance-like qualities as physical metal. The precious metals community often debates this distinction with religious fervor. Physical advocates warn that paper claims are dangerous. Paper advocates argue that physical holders are paranoid. Both sides miss important nuances. Physical metal serves specific purposes: emergency reserves, true portfolio insurance, independence from financial intermediaries. But it comes with costs: storage, insurance, liquidity constraints, and the inability to earn any return. Paper vehicles serve different purposes: tactical trading, easy liquidity, portfolio allocation without storage concerns. But they introduce risks: counterparty failure, tracking errors, and less protection in true crisis scenarios. The intelligent approach recognizes that different tools serve different needs. Absolute positions on either side suggest dogma rather than strategy. This brings us to one of the most common and most dangerous mistakes precious metals investors make: overconcentration. Because these assets attract fear-based thinking, investors sometimes abandon diversification entirely. They convince themselves that only gold and silver will survive the coming crisis. They put 50%, 70%, even 100% of their wealth into precious metals. This is financial suicide dressed up as prudence. No matter how strongly you believe in any asset class, concentration creates risks that can destroy you even when you're fundamentally correct. Markets can remain irrational longer than you can remain solvent. Prices can move against you for years. Liquidity can disappear when you need it most. Unexpected events can create correlation where you expected diversification. Professional portfolio managers generally suggest that precious metals should represent somewhere between 5% and 20% of a diversified portfolio, depending on individual circumstances and risk tolerance. This provides a meaningful exposure without creating catastrophic risk if you're wrong or poorly timed. Yet I regularly encounter investors with 50% or more in precious metals. They rationalize this by pointing to specific scenarios where only gold would preserve value. They're not wrong about those scenarios, but they're wrong about probability-weighted outcomes. Concentration might be appropriate for speculators trading with capital they can afford to lose. It's not appropriate for people protecting life savings or retirement funds. Another critical danger involves timing. Many investors approach precious metals as if perfect timing is necessary or even possible. This creates paralysis and poor decisions. You'll hear people say, "I'm waiting for silver to drop to $20 before I buy." Or, "I'll sell my gold if it reaches to as $300. These specific targets feel precise and intelligent. In reality, they're often arbitrary and counterproductive. Markets don't care about your entry point. They don't know you're waiting at specific levels. They move based on supply, demand, sentiment, and positioning dynamics that have nothing to do with your trading plan. The investor waiting for the perfect entry often waits forever. Prices rise and they can't bring themselves to buy higher than they originally planned, or prices drop to their target. But by then, sentiment has turned so negative that fear prevents action. Similarly, investors who sell based on arbitrary price targets often cut profits short during the most powerful part of bull markets. The real money in precious metals comes from holding through extended advances, not from trying to trade the range. This doesn't mean timing is irrelevant. It means that precise timing is impossible, and strategies should account for this reality. If you currently hold gold or silver, you face specific decisions that require honest self-examination. Let me walk you through the key questions you need to answer. First, why did you originally buy? Be honest with yourself. Was it insurance against system failure? Was it inflation protection? Was it speculation on price appreciation? Was it fear of missing out during a rally? Your original reason matters because it determines whether your position still makes sense. If you bought as insurance and that need still exists, price movements shouldn't affect your decision. Insurance doesn't stop being valuable just because you haven't filed a claim yet. But if you bought expecting quick profits and years have passed without those profits materializing, you may be holding a position that no longer aligns with your actual goals. Second, what percentage of your portfolio do these metals represent? Has that percentage grown or shrunk with market movements? Does it still reflect your risk tolerance and financial situation? Many investors buy a 10% position, watch it grow to 30% during a rally, and never rebalance. This is how insurance positions accidentally become speculative overexposures. It's how diversified portfolios become concentrated bets. Third, do you have a plan for different scenarios? What will you do if prices rise another 50%? What will you do if they fall 30%? If you don't have answers to these questions, you're not prepared. And unpreparedness leads to emotional decisions. Some of you watching this are considering whether to sell your precious metals positions. You're feeling uncertain, prices have moved, your situation has changed, or your conviction has weakened. Let me offer you a framework for this decision. Selling is appropriate when one or more of the following conditions exists. Your financial situation has changed, and you need the capital for more pressing purposes. Your portfolio has become unbalanced, and rebalancing serves your overall financial health. The reasons you originally bought no longer apply. You've honestly concluded that you made a mistake, and holding serves no purpose. You're losing sleep over the position, indicating it's larger than your emotional tolerance can handle. But selling is usually a mistake if you're motivated by these factors. Price movements in either direction, day-to-day news that creates temporary anxiety, what you read in forums or hear from other investors, boredom from holding an asset that hasn't performed recently. Here's a critical insight. If you bought precious metals properly, as insurance or long-term diversification, then price movements shouldn't trigger sales. You don't cancel your homeowner's insurance because you didn't have a fire this year. If you bought speculatively, hoping for quick gains, then you probably shouldn't have bought them at all. Precious metals are not suitable for speculation unless you deeply understand these markets and can tolerate extreme volatility. Let me give you a specific, actionable strategy that successful precious metals holders have used for decades. This is called systematic rebalancing, and it solves multiple problems simultaneously. Choose a target allocation, let's say 10% of your portfolio. Review quarterly. When precious metals grow beyond 12% of your portfolio, sell enough to return to 10%. When they fall below 8%, buy enough to return to 10%. This simple discipline forces you to sell strength and buy weakness. It prevents overconcentration during rallies. It builds positions during corrections. It removes emotion from the process. Does this mean you'll miss the top tick of bull markets? Yes. Will you buy the exact bottom? No, but you'll capture most of the upside, protect yourself from concentration risk, and maintain balance through all market conditions. The specific percentages matter less than the discipline. Whether your target is 5%, 10%, or 15% is less important than sticking to whatever target you choose. Many successful investors modify this approach by having both a core holding and a trading position. The core, maybe 5 to 7% of the portfolio, never gets sold. It's permanent insurance. The trading position, another 3% gets rebalanced systematically. This provides the best of both worlds, permanent protection plus tactical flexibility. Now let's address those of you who don't yet own precious metals, but are considering an entry. Your questions are different, but equally important. The most common question is, are prices too high to buy now? This question seems logical, but reveals a fundamental misunderstanding of how to approach these assets. If you're buying precious metals as long-term insurance or diversification, then current prices are largely irrelevant. You're not trying to predict next month's or next year's price movements. You're establishing a permanent position that serves a specific portfolio function. Yes, buying during a correction is better than buying during a rally, but waiting indefinitely for perfect entry conditions usually means never buying at all. The investor who refused to buy gold at $1,500 because they were waiting for $1,200 likely never bought, even when it briefly touched $1,300. Instead of asking whether prices are too high, ask whether precious metals serve a purpose in your financial life. Do you have adequate emergency reserves? Are you overexposed to currency-denominated assets? Does your portfolio lack true diversification? Would you benefit from an asset that often moves independently of stocks and bonds? If the answer suggests that precious metals fill a gap in your financial structure, then establishing a position makes sense regardless of current price levels. If you've decided that precious metals belong in your portfolio, let me give you a smart entry strategy. Don't attempt to buy your entire intended position at once, especially if you're new to these markets. Consider a systematic entry over 6 to 12 months. Divide your intended investment into equal portions. Buy one portion every month or quarter, regardless of price movements. This approach, called dollar cost averaging, solves several problems. It prevents the psychological damage of buying everything at what turns out to be a temporary top. It forces you to become comfortable with volatility while positions are still small. It removes the pressure of trying to time the market perfectly. Yes, if prices trend strongly upward during your accumulation period, you'll pay higher average prices than if you'd bought everything immediately. But if prices trend down, you'll benefit from lower average prices. And most importantly, you'll actually follow through instead of freezing. For most people, dividing their intended precious metals allocation into 6 or 12 equal purchases made systematically over time produces better results than attempting to time a single entry. If you're new to precious metals, you'll need to decide between physical metal and financial products. Let me give you clear guidance based on your situation and goals. For true beginners building their first position, I generally recommend starting with physical metal, despite the costs and inconveniences. Here's why. Owning physical metal teaches you the reality of these assets in ways that paper ownership cannot. When you hold a gold coin or silver bar, you viscerally understand that this is different from a stock or bond. You can't click a button and sell it in seconds. You have to store it. You have to protect it. You have to accept that it doesn't generate income. These apparent drawbacks are actually teaching tools. They instill the patience and long-term thinking that precious metals require. They prevent the impulsive trading that destroys wealth. Start small. Buy a few gold coins or a modest amount of silver. Experience what ownership actually means. Then, once you understand the asset class through direct experience, you can decide whether exchange-traded funds or other vehicles make sense for additional exposure. For larger allocations, or for investors who already understand these markets, exchange-traded funds backed by physical metal provide sensible exposure without storage concerns. But master the basics through direct ownership first. Regardless of whether you currently hold precious metals or are considering entry, you need to adopt what I call the insurance mindset. This changes everything about how you approach these assets. Think about your car insurance. You pay premiums year after year, hoping you'll never need it. When you don't have an accident, you don't call your insurance agent and complain that you wasted money. You understand that the absence of catastrophe is precisely what you're paying for. Precious metals work the same way when approached correctly. You're paying, through opportunity cost, storage fees, or simply foregoing higher returns elsewhere, for protection against specific risks. If those risks never materialize, you haven't lost. You've simply received exactly what you paid for, protection. This mindset prevents the emotional turmoil that destroys most precious metals investors. If gold sits unchanged for 3 years while stocks rally, you don't feel stupid, you feel protected. Your insurance was there if you needed it. If gold rallies sharply, you don't get greedy and overconcentrate. You rebalance, taking some profits, because insurance policies aren't meant to become your entire net worth. This approach sounds simple, but it's psychologically difficult to maintain. Human nature pushes us toward greed during rallies and despair during corrections. The insurance mindset provides an anchor against these destructive impulses. Let me now give you a direct list of behavioral traps that destroy precious metals investors. Read these carefully. If you recognize yourself in any of these descriptions, stop and reassess immediately. This is the most common error. Precious metals are not businesses. They don't grow. They don't innovate. They don't compound. If you approach them expecting stock-like behavior, you'll make stock investor mistakes that don't apply here. Stop checking prices daily. Stop worrying about quarterly performance. Stop comparing precious metals. Returns to stock market returns over short periods. They're different assets serving different purposes. Every week brings new headlines that seem urgent. Interest rate decisions, inflation reports, geopolitical tensions, bank failures, political elections. Most precious metals investors react to these headlines emotionally. They buy in fear. They sell in panic. They switch between optimism and pessimism based on each news cycle. Professional investors develop positions based on long-term structural factors, then hold those positions through short-term noise. The news you think is important today will be forgotten next month, but your emotional trading decisions will impact your wealth for years. The precious metals. Community is filled with personalities who make dramatic predictions. They forecast specific price targets. They promise imminent breakouts or crashes. They speak with absolute certainty about uncertain outcomes. These people may be well-intentioned. They may even occasionally be right. But following them is financial suicide. No one knows what markets will do in the short term. No one. And those who speak with the most certainty are usually the least trustworthy. Build your own understanding. Make your own decisions. Use other people's analysis as input, not as instructions. Some investors, frustrated by the slow movement of physical metals, turn to leverage products like futures contracts or options. They reason that if gold is going higher, they might as well maximize their exposure. This is how most precious metals speculators blow up. Leverage transforms volatility from uncomfortable to catastrophic. A 10% move in gold becomes a 50% or 100% move in a leveraged position. Most traders can't handle this psychologically or financially. Unless you're a professional trader with deep experience and capital you can afford to lose entirely, stay away from leveraged precious metals products. They're wealth destroyers for amateur investors. I regularly encounter investors with 60% of their wealth in precious metals, no emergency fund, inadequate life insurance, and no retirement savings. They've convinced themselves that only gold matters. This is not prudence. This is extremism masquerading as preparation. Financial security requires balance. It requires multiple asset classes, adequate liquidity, proper insurance, and diversification across different risks. Precious metals are one component of sound financial planning. They're not a replacement for it. You'll encounter countless predictions about where gold or silver is heading. 5,000 gold is inevitable. Or 100 silver is coming. These predictions are entertaining, but basing your decisions on them is dangerous. Markets don't move in straight lines to round numbers. Even if these prices eventually arrive, and they might, the path will be volatile, with corrections that shake out everyone who bought based on price targets rather than sound strategy. Buy because precious metals serve a purpose in your financial life. Hold because that purpose remains valid. Sell when circumstances change. Never make decisions based on someone's price forecast, including mine. Precious metals experience deep corrections, even during long-term bull markets. The 2011-2015 gold correction saw prices drop nearly 45% from peak to trough. Many holders who bought for sound reasons panicked and sold, often near the bottom. If you sized your position correctly and bought for the right reasons, corrections are buying opportunities, not reasons to panic. The insurance mindset I described earlier protects you from this mistake. The opposite mistake is equally destructive. When precious metals rally sharply, new investors pile in, often right before corrections. They're motivated by fear of missing out, not by sound financial planning. If you're buying because prices are rising fast and you feel left behind, stop. You're making an emotional decision that will likely end badly. Wait for emotions to settle, then build a position systematically if it makes sense for your situation. We've covered substantial ground in this presentation. Now let me bring it all together with the perspective that matters most: what you do next. If there's one message I want you to take from this discussion, it's this. Precious metals are not mystical assets that require perfect timing and prediction. They're financial tools that serve specific purposes when used intelligently. The danger facing gold and silver holders isn't market collapse or price crashes. The danger is making poor decisions based on emotion, misunderstanding, or unrealistic expectations. Most investors who lose money in precious metals don't lose because the metals failed them. They lose because they failed to approach the metals correctly. If you currently hold positions, assess them honestly. Do they still serve your needs? Are they sized appropriately? Do you have a plan for different scenarios? If the answers are yes, then stop worrying about daily price movements and maintain your discipline. If you're considering entry, ask yourself the right questions. Do precious metals fill a genuine gap in your financial structure? Can you maintain a long-term perspective through volatility? Are you prepared to own assets that may not perform for extended periods? Most importantly, abandon the search for certainty. No one knows whether gold is heading to $3,000 or back to $800. No one knows whether silver will reach $50 or fall to $18. These unknowns are not weaknesses in your planning. They're the reality of all financial markets. What you can control is your strategy, your discipline, and your emotional responses. You can control position sizing. You can control rebalancing. You can control whether you make fear-based or logic-based decisions. The investors who succeed with precious metals over decades aren't the ones who predict markets correctly. They're the ones who understand their purpose, maintain appropriate exposure, and refuse to let emotions override strategy. You don't need perfect timing. You need adequate preparation. You don't need maximum returns. You need sustainable, balanced wealth building. You don't need to know what happens next. You need to be prepared for whatever does happen. Remember that financial markets are marathons, not sprints. The decisions you make today will compound over years and decades. A small position maintained with discipline will serve you better than a large position abandoned during the first serious correction. Precious metals have preserved wealth for thousands of years. They've survived the collapse of countless currencies, governments, and economic systems. They'll be here long after today's concerns fade into history. Your task isn't to outsmart markets or predict the future. Your task is to build a financial structure that serves you through different environments, using the right tools, in the right proportions, for the right reasons. If you approach gold and silver with this mindset, as portfolio components serving specific purposes, held with discipline, sized appropriately, and managed without emotion, then you're not in danger. You're prepared. The danger comes when you abandon this framework, when you speculate instead of invest, when you concentrate instead of diversify, when you react instead of plan. I began this presentation by telling you that gold and silver holders face danger. That danger is real, but it's not inevitable. It's entirely within your control. The question is whether you'll exercise that control or surrender to the emotional impulses that destroy most investors. The choice, as always, is yours. Choose wisely. Choose based on reason rather than fear. Choose strategies that you can maintain for years, not days. Choose balance over extremes. And remember, the goal isn't to get rich from precious metals. The goal is to preserve and grow your overall wealth through time, using every appropriate tool available, including but not limited to gold and silver. Thank you for your time and attention. Whatever you decide, I hope this presentation has given you a clearer framework for those decisions. The rest is up to you. Stay disciplined, stay balanced, stay focused on the long term. That's where real financial security is built.